Recently, I was in a group mentoring session with a long-standing options trading student of mine. We were reviewing one of his trades, and he mentioned that on this one particular day he had reached his target profit on a trade, but in hopes of making more than target, which is a completely legitimate desire, he ended up squandering the entire profit because the market made a large move the next day and never looked back. The trade ended up in a loss. While not as dangerous and reckless as ignoring your stops, traders who ignore their target profits are playing a sloppy game of messing with their annual returns. After all, no professional options trader would go live with a trade using firm capital, or their own capital for that matter, without extensively backtesting and stress testing it in many different kinds of market conditions. Since target profit trades often comprise a large percentage of the annual returns of a trade, squandering the profits from a trade that has hit target is a big deal. A typical annual return for market neutral options trades is 30%. If your target profit's 10% on a trade, which is really a pretty modest profit target in this style of trading, by failing to realize that gain, you are toying with 1/3 of your annual gains. When traders are up money, they can sometimes forget that every day they stay in that trade, they are risking that entire profit. That's actually an irresponsible thing to do when the premise of your trade is an expectancy that includes those nice big wins. Having said that, there are certain cases where a trade is setting up so nicely that it's reasonable to expect that you may be able to make more out of it than target. This will often happen right after a period of high volatility where you can get paid very nicely for risks of a market neutral options trade. If the market implied volatility drops significantly after trade entry without the accompaniment of a huge move in the market, that is a setup for a very nice month typically. If your profit target gets hit very early in the trade, which can happen in these circumstances, it's possible that staying in the trade is not the craziest idea in the world. Yet, you risk giving up the windfall of a critical large win if you don't take the trade-off. So, what to do? There are two relatively simple solutions to this dilemma. One solution is to establish a trailing stop on the trade so that you lose no more than 1/3 of your achieved target profit in the event that the market makes a big move after you hit target. This is not an unreasonable thing to do in some circumstances, although I'd say that this only makes sense if, within your judgment, the chances of you making more out of the trade is at least a bit better than giving back 1/3 of the profits. If you've made that judgment, I think that it is a sound approach, although you need to realize that if your trailing stop gets hit, your returns that year will not be as positive as they could have been had you simply exited the trade at target, as you might have, for example, in a back test. A second solution is to take profits on 2/3 of your position, leaving 1/3 still in play. That way, if you're right, you'll be able to milk the trade for more potential profit while locking in the profits of the lion's share of the trade. Personally, I prefer the latter idea, pulling capital off the table when I hit target. That way, I can be assured I've locked in the majority of my gains on the trade without exposing a large amount of capital if volatility should pick up at a later date. Regardless of how you handle things, it's pretty irresponsible to ignore having hit your target profit on a trade. It's a possible sign of greed, cockiness, and overconfidence, and can cost you dearly in the wrong kind of circumstances. Honoring your target profit is almost as important as honoring your stops, and can be just as damaging to your annual returns.